Welcome to Financials with Ahao. It's a joy to be together with you again as we continue on the Making Wealth series. And we're building up on a new conversation where we are talking about financial tools that are relevant for Africa. It's such a new area for me, something I'm also exploring as we learn together, but it's also building up on what I shared last time when I have been reading and learning about finance, and there are things which I just read and I'm like, oh no, this makes absolutely no sense to me. So just coming to the space where I'm asking myself what words, what terms, what areas of financial and personal development in that area are relevant to Africa and that we can learn about together. So today I'd like us to talk about just what it means when we talk about income and how income is done on this continent or in this region, West Africa and Kenya in particular, and just understanding the basic thing, which is a pay slip. I remember talking to a young lady a few weeks ago, and we were just having a conversation on, like what the workspace looks like as an employee, what does it mean, and how does that, kind of pan out for her. And the first thing I'd like us to look at is when someone is employed, they have employment income. And employment income is usually either in form of a salary or a wage. That's what we call it in this region. Those are the two terms we interchangeably use. And from that, we're able to now have different things that are deducted. And these deductions for us are called statutory deductions, which are made to the government through certain government bodies that administer different things for us as citizens of the country. So let's take a salary. So a salary will first be communicated as a gross salary. A gross salary means this is what someone will earn with all the things that could be deducted before they are deducted. So, for instance, if I'm told my gross salary is 50,000, it means that on my employment letter, it will be written my gross salary is 50,000. But later, I will get something less because there will be certain deductions. And the lesser amount that I get is then called a net salary. So these terms are used a bit commonly, so they're easy to understand. So now we need to find out what happens between the gross and the net so that we know what changes come into place. And I've talked about statutory deduction. And for instance, in Kenya, the first statutory deduction is done to the Kenya Revenue Authority. So that's tax. And that's usually done in tax brackets. Depending on how much someone earns, it goes increasing. There's a minimum amount which is not taxable. After that, subsequent amounts go on being taxed in different tax brackets. The second deduction that is done is the National Hospital Insurance Fund. And currently that deduction is done before tax because it is now tax deductible. And that again is also done based on the income bracket that an individual is in. The next deduction is the National Social Security Fund. And that is also done by taking a certain amount that will be kept by the National Social Security Fund that someone will access at retirement. So for this kind of retirement is an age-based retirement where we have an early retirement at 50 years and the statutory retirement age at 60 years. And this is divided into two. There's a provident fund, which is where part of the money goes, and then there's also a second fund where the other part of the money goes, but eventually it is collated as one. Now, something good with this particular one, because this is actually part of the pension, is that it also is tax deductible, and an individual can actually allow themselves to be deducted up to a maximum of 20,000 Kenya shillings per month, which also supports the tax deduction that they're able to get. The next statutory deduction that will happen on someone's salary is the NITA. NITA is a training levy, and that is usually around 50 shillings. And that enables an individual to be part of trainings that are offered by the National Industrial Training Authority that makes them eligible for certain learning programs at reduced rates. The next deductions that can be made, so those are the main ones. The next deductions that can be made is if the particular organization has an additional pension plan. Many can do what is called a matching principle, where they say we are going to pay for you As the 10% will be deducted from your salary as pension, and we're going to match it at 10%. That's also another deduction. So this next level of deductions from the pension are not statutory, but they're deductions that may be made based on the kind of contract that a person has entered into. Another deduction that can be made is a health cover deduction, where you find an institution might offer a health cover and seek to also support. So these are a few things. We'll continue to build up on them. Thank you for listening.